Hello ladies and gentlemen, welcome back to the channel. In today's video we're going to be taking a look at different types of stocks that you can invest in as an investor, as an individual. I know last Monday, I believe it was, we made a video on just what is a stock, breaking down the basics of a stock. I believe it was about a 10 to 15 minute video on that. So if you haven't checked that out and you're looking to learn about various things in investing, go ahead and watch that video, then come back to this video. This will be a good segue and continuation of that video. So we're going to get right into it. Types of stocks, Finance 101 series. So you have three main classifications of stocks. You have small, mid, and large cap. And I've done a sort of breakdown in my Roth IRA video that I know a lot of people have seen on the different, whether I like these and, what mutual funds I invest in for these small, mid, and large cap stocks. And here's a hint, if you haven't seen that video, I like all of these stocks, and I know a lot of investors do like a mix of all three of these kinds of stocks. So let's start it out with the large cap stocks. A large cap stock these are stocks of large companies with market capitalization over $10 billion. If you don't know what market cap is, you can go to a Yahoo Finance or a Morningstar or even Google, and they have a market cap segment, and it'll say, let's say if it's Apple, they were sitting around like $2 trillion. So obviously that's well over the 10 billion here. If I can pull up my pointer, there we go. So well over that 10 billion here, 2 trillion. So they are obviously a large cap stock. These are few in number, but account for over 75% of the total market value of all U.S. equities. So these are going to be very common to find on the S&P 500, since those are the largest cap or largest stocks in the United States. So you have your Apples, your Microsofts, your Amazon, your Googles, all these really big companies would be classified as large cap stocks. And as we continue going down, I'm going to hit back on these real quick. So then we have mid cap stocks, stocks of medium sized companies with market capitalizations between $2 billion and $10 billion. These provide opportunity for greater capital appreciation than large cap stocks, but less price volatility than small cap stocks. So this is just kind of like a happy medium. These are the Goldilocks stocks. These are what, if Goldilocks was an investor, she'd really like these mid cap stocks just because they're right in the middle. Not quite as risky as small cap stocks, but not quite as safe as large cap stocks. So you still have more potential for growth. And then we have small cap stocks. These are stocks of small companies with market capitalizations less than $2 billion. So these are essentially all the rest. If that thing will move real quick, generally have annual revenues of less than 250 million, usually not widely traded. Liquidity is an issue with some of these things. I know one of the big ones currently, if you stay up to date with Barstool Sports at all, Penn was a small cap stock, but I believe their market cap is now around 10 billion. So I guess technically they're not in the mid, or they're now in the mid caps. Or even large cap, I have it. They might be around 7 billion. I could be wrong on that, but I know in the Schwab small cap portfolio that I'm invested in, Penn is the biggest holding in that, just because they've had an astronomical growth in their stock price over the course of these last several months, just because Dave Portnoy is a marketing genius, whether you guys like him or not. And one of the big draw factors of small cap stocks, you hear people like Dave Ramsey talk about small cap or aggressive small cap growth funds, which is a mutual fund that focuses on small caps that have good potential for growth. So small cap stocks are going to be more risky just because they're not quite as big. They don't have quite as many assets. They might have more liabilities. All of these things play a factor. They may not have the street cred, if you will, that something like an Apple has. So these small cap stocks are going to be more risky, but potentially, like with all stocks, the riskier it is, the higher the expected return on these. So I mean, a small cap stock could return 15%. Whereas a large cap stock could return 4%. But it's the risk you take. You have the safety of a large cap, and you have the aggressive growth potential of a small cap. And if you want to get even riskier, you can go into emerging markets. But those are all different funds, so we won't dive too deep into that. But in emerging markets, they could potentially turn 20%. So it's the risk. There's a risk and reward balance, and it's all based on each particular investor and what they view as a good risk to reward balance. So next slide here, speculative and tech stocks. So let's start with the speculative stocks. These are stocks that offer potential for substantial price appreciation, but lack the sustained records of success. So these are kind of like the small cap stocks that we've been talking about. These are attractive, particularly when the market is bullish, just because, over the course of, I guess, even the last 6 months, everything was green. Now it's back down again. But everything was bullish. It seemed like, stocks only go up, which obviously isn't the case. But over time, I guess technically it is true. So these would make these speculative stocks pretty attractive because you could see that 10, 20, 30% growth on something like this. These offer attractive growth prospects with a chance to hit it big in the market. I mean, I guess you could throw penny stocks into this. What a penny stock is usually under $1 for the face value of a stock. Whether it's like a J.C. Penney's. I know J.C. Penney's has been hit really hard. In my personal opinion, you should just stay away from penny stocks, just as a disclaimer. But these are also anything under $3 can be thrown into a penny stock range too. But if you have a penny stock and it's a $3 stock, and within a month or two, it could be a $6 stock, and if there aren't things going on behind the scenes, some shady dealings there, obviously that's a quote unquote good investment, but the risk on these things are so incredibly high. I guess you could probably throw a Tesla in here. Tesla's pretty speculative. I believe their beta is around 2.5%, so that's 150 times riskier than the average stock or than the S&P 500. So I guess that's pretty speculative there. But obviously the return on something like Tesla is astronomical. They're up from whatever it was, $200 a share, up to $22,000, $2,500, that range, and then they split. Now they're kind of settling back down, but obviously that's a pretty massive gain on a stock like Tesla. Then we go down to tech stocks. These are stocks representing the technology sector of the market. Very, very straightforward on these. These are the vast majority of these stocks are traded on the NASDAQ, which has been slammed over the course of the last month or so. So obviously tech stocks haven't been super pretty, but these offer potential for very high returns, but also involve considerable risk and volatility. Obviously now with whether you look at like a Zoom stock that has just had a meteoric climb and then kind of a little bit of a fall, but now a steady a stagnation there a little bit, or an Apple stock. Obviously a company like Apple stock is always going to be around. Obviously a company like Apple is always going to be a leader in their field, or whether it's a Microsoft, no matter what it is, they're always going to be there. But these companies, or a Facebook, which I would say Facebook's a little riskier than Apple or Microsoft, but these companies are always going to be there. It's just a matter of when is it really their time to shine? When do people have the money to go out and buy a new iPhone? When do people have the money to go out and buy a new computer or whatever it may be? So they can kind of ebb and flow with the gauge of the market. But these are really obviously Apple was the biggest company at that $2 trillion. I don't know. I believe they're still the biggest company, but I don't think they're worth $2 trillion anymore. But obviously, there is some of that risk involved with these companies, even with such big names. Then we have cyclical and defensive stocks. Cyclical stocks are stocks issued by companies whose earnings are closely linked to the overall economy. So if the economy is doing well, then cyclical stocks will be doing well. If the economy is doing poorly, then cyclical stocks aren't going to do very well. These could be looked at as airlines. Airline stocks have been absolutely slammed. Obviously, travel isn't going on as much as it has been in the past. So you see airline stocks getting slammed. I would count those as cyclical. You could throw cruise stocks in here. And then we have some of these examples down here: Alcoa, Caterpillar, Genuine Parts, and Lennar. All of those would be considered cyclical stocks. I guess to read a little bit more into this, stock price tends to move up and down with the business cycle, like we just said, and tend to perform poorly in weakening economies. So those are all very self-explanatory parts of cyclical stocks. So when the market's good, cyclical stocks are doing really good, and when it's bad, cyclical stocks are doing really bad. So I guess if you can, obviously you can't time the market, but if you can buy these stocks in the dip or whatever it may be, these stocks could have great returns for you. And obviously a company like Caterpillar is relatively safe, but they're still swayed by whether it's construction or whatever it may be, or just people buying new machines that they manufacture or whatever it may be. It's swayed by the business cycle regardless. Then we have defensive stocks, stocks that tend to hold their value and even do well when the economy starts to falter. These would be a good pair with cyclical stocks simply because defensive stocks are usually a pretty safe bet. One of the big ones we've seen, or I guess big sections of a defensive stock that we've seen, it would be groceries, I should say. We have listed in there Walmart, but you could throw a Kroger stock in there. Kroger really boomed. I believe it was around $20 when the whole virus situation started, maybe even as low as $16. Now it's around $32 a share. You have a Target. Target's always done well. You can throw a Costco in there. All of these, I guess you could even throw a Lowe's potentially in here. Lowe's did really well over the course of these last several months. These tend to be less susceptible to downswings in the business cycle than average stocks. These include public utilities and consumer goods firms. So I guess you could throw like a Public Storage. I really like Public Storage. You could throw a Waste Management in here. These are companies that are always going to be around regardless of how bad the economy looks, unless something really major happens to a Walmart or whatever it may be. Walmart will always be around. Unless obviously Amazon overtakes everything, then Amazon will be the leader here. But in my personal opinion, Walmart will always be around. Waste Management should always be around. Public Storage, people are always going to need places to store the thing. So these are all really good defensive stock examples that I can think of here. So defensive stock is a good counterpart to cyclical stocks. You can potentially see more growth in cyclical stocks, but some defensive stocks can either pay like a good dividend, or they just have that steady growth and that peace of mind factor along with them. Then we have two more, income stocks and blue chip stocks. Let's start with the blue chip stocks. These are stocks issued by large, well-established firms with long track records of earning profits and paying dividends. These companies are often leaders in their industries, less risky than most stocks, appeal to investors who want to earn higher returns than bonds without taking a great deal of risk. And then we have two listed here, which are Coca-Cola and McDonald's. Those are really good ones. They consistently pay a dividend. I believe Coca-Cola is a dividend aristocrat, if not a dividend king. I think McDonald's is also a dividend aristocrat. I don't think they're a dividend king, but I could be wrong there. If you don't know what a dividend aristocrat is, they've been paying dividends for 25 years straight and continually increasing that dividend. And obviously in times like these, that's obviously hard to maintain. So when you see a company like whatever it may be maintaining a dividend, that's usually a pretty good sign that they're a pretty well-run company. And you throw them into these blue chip stocks. These are just really solid companies that you could potentially fall back on for a little bit of growth, but also paying a solid dividend. Then we have income stocks. These are stocks with a long history of regularly paying higher than average dividends. So these are ideal for investors seeking relatively high levels of current income. Dividends tend to increase regularly over time. You could throw an American Electric Power or Duke Energy, or American Electric Power and Duke Energy, as well as Apple, General Mills, and Altria Group. General Mills is a pretty safe bet. Apple's a pretty safe bet, but like I said here, stocks with a long history of regularly paying higher than average dividends. If Apple does really well, potentially they're going to pay that money out in form of a dividend rather than just putting it straight back into the company. They kind of reward their investors a little bit there. So these are some of the main ones we see with the income stocks. So that's going to wrap it up for this video. Hopefully you guys learned something throughout these various types of stocks that we explained in this video. If you did, or if at any point you enjoyed something you saw, go ahead and hit the like button. That's the best way to show your support for the channel and kind of push this video out to everybody. I'll also leave it in the comment section below another Finance 101 segment you'd like me to cover, something you think would be very useful for either yourself or for other people that you haven't seen a whole lot of on YouTube, and I'd be happy to make a future video on it. And also subscribe to the channel. We're very close to 250 subscribers, and we continue our climb to 1,000 subscribers, and hopefully we'll get there potentially by the end of the year. If not, we're going to continue producing great content into next year and continue that climb from there. So once again, I really appreciate everything from you guys for watching these videos, and until next time, happy investing.